Hi guys, welcome. This video will introduce you to the key workings needed to prepare the consolidated statement of financial position. The idea behind consolidation is that we take 100% of the parent's figures and add it to 100% of the subsidiaries' figures. This is known as acquisition accounting, where we just add across the company's assets and liabilities on a line-by-line basis. But the only difference is that share capital and share premium is that of the parent only. The basic principles that the parent will show is that we must understand the group structure to identify what the controlling interest is and what the non-controlling interest is, and when the parent gained control of the subsidiary. Was it 6 months ago or was it 6 years ago? Because this could have depreciation implications. Further, we must be able to produce the net assets of the subsidiary. This will help with the key workings described in another video. The key workings are made up of goodwill, NCI, and the consolidated retained earnings, also known as the reserves. The parent must produce a working and show the working to all of these three calculations, and then these figures are shown directly on the face of the consolidated SFP. Here is the basic format. Assets and total assets is the top half of the balance sheet. Capital and liabilities are the bottom half of the balance sheet. Remember that we are doing group accounting. We show the parent and the subsidiary as if they are a single entity. So any intra-group transactions must be eliminated, plus the key workings and any other adjustments should ensure that the parent's consolidated SFP will balance. Let's take a look at this very simple example and try to identify what the group structure is going to be. Postal acquired 60% of Steeple on the 1st of October 14. That means the 1st of October 14 is the acquisition date, the day the parent gained control over the subsidiary. On this date, the retained earnings of Steeple were 34,000. And at September 18, a few years later, the statement of financial position extracts for both of the companies were as follows. So you're given the latest financial statement extracts. You're given the share capital and the retained earnings of Postal and Steeple. Required, show the group structure. The group structure aims to show the parent what the controlling interest is and what the non-controlling interest is. So we have P, Postal, the parent, and then the P owning shares in S, the subsidiary, Steeple. Since Postal acquired 60% of Steeple, that means that Postal has 60% control over Steeple. Therefore, the remaining 40% is the non-controlling interest, which represents the shareholdings that is not having control over the subsidiary. And it is very important that we establish what the percentages are, because that's what the parent's going to use when doing the key workings for goodwill, NCI, and the retained earnings. Now let's talk about the net assets of the subsidiary. Once the group structure has been established, we now need to know how the subsidiary has changed since the acquisition date took place. The net assets is done for the subsidiary only, and we show the subsidiary's equity structure and any other changes to the subsidiary at 2 points in time, at the date of acquisition and at the date of consolidation. Let's talk about each item on a line-by-line basis. Starting off with share capital. We must show the subsidiary's share capital at the date of acquisition and at the date of consolidations. These two figures will be the same because we assume that once the parent gains control of the subsidiary will not issue any more shares. The share premium account will be similar. We must show the share premium at 2 points in time, and these two figures will always be the same because since the share capital is unchanged, the share premium will be unchanged. Then we've got retained earnings. Retained earnings are not going to be the same at 2 points in time. We must be very clear that the parent should identify what the retained earnings are at the date of acquisition and what the retained earnings are at consolidation. We expect the subsidiary to grow, so therefore the two numbers will be different. If the parent has shrunk, i.e. they made losses, then again the two figures will be different. But we must be able to identify what the retained earnings are at those 2 points. The next line is FVA, which stands for fair value adjustment. This fair value adjustment is done upon consolidation, when the market value of the subsidiary's assets is different to the book value of the subsidiary's assets, so we adjust for it. Now I've put minuses there, but it could be pluses here as well. Whatever you put in the first column will be the exact same mirror in the second column. It could be plus or minus depending on the situation. And there is a separate video on fair value adjustment. The next line is any post-acquisition depreciation. If you need to do a fair value adjustment, then this could mean further depreciation implications. So this could mean that if your assets have gone up in value, then you'll have to charge a greater depreciation expense. If your assets have gone down in value, then you may need to lower your depreciation expense and add it back. So you must be very careful in order to put the correct figures in these boxes here. And the final line would be the provision for unrealized profit, PUP. If the subsidiary and the parent trade with one another and the subsidiary made a profit, this profit is not allowed to be included in the consolidated accounts. This must be eliminated because it's an intragroup transaction. And it is eliminated in the consolidation account only because it's the profit that you've made in that year alone. So we just put it in that box there. So we add down both columns, and these totals are very important because we're going to be using these totals to help us calculate the next three workings for goodwill, NCI, and retained earnings. But there could be other items appearing in the net assets table. For example, let's say the subsidiary has an equity investment. Let's say a subsidiary is investing in another company's shares. This investment could go up in value or could go down in value. And this movement in the values is shown on the net assets table. So there could be some other items to be shown on the net assets table, but here is the most basic of them all. And there you have it, guys. An introduction to the workings. Let's apply this introduction to this example here. Postal acquired 60% of Steeple on the 1st of October 14. This is the same example that we've seen when preparing the group structure of Postal and Steeple. What the requirement is show Steeple's net assets. Well, the net assets of Steeple is going to be the share capital figure and the retained earnings figure, and that's it, because I can't see any other information that would appear in the net assets table. So what we have here, at the date of acquisition, the share capital is 30,000, and at the date of acquisition, the retained earnings of Steeple were 34,000, giving their total to be 64,000. Whereas at consolidation, the share capital again is 30,000. However, the retained earnings at September 18 was 72,440, giving you a total of 102,440. And there you have it, guys, the net assets of a subsidiary.